Welcome back to the Microlearning Institute. In this tutorial we look at part A of question number 2 from the December 2013 DIP IFR setting, and this is called delta. In this question we're told that delta is an entity which prepares financial statements to the 30th of September each year. During the year ended the 30th of September 2013, the following transaction occurred. On the 1st of April 2013, Delta subscribed for $40 million $1 loan notes in Epsilon. The loan notes were issued at 90 cents and under the terms of issue were redeemable at $1.20 on the 31st of March 2018. Interest is payable by Epsilon on the 31st of March in arrears at 4% of the par value. This represents an effective annual rate of return for Delta of 9.9%. Delta's intention is to hold the loan notes until redemption. So, if Delta intends to collect the contractual cash flows until redemption, IFRS 9 tells us that this will be classified on the books of Delta as a financial asset. And if this is the case, it will be measured using an amortization table at its amortized cost. So let's look at the amortization schedule for the financial asset on the books of Delta. So initial recognition of the financial asset will be at fair value. And of course the fair value is the 40 million loan notes that were required at 90 cents. So 40 million by 90 cents shows that this financial asset will be initially recognized at $36 million. Interest for year ended the 30th of September 2013, which is 6 months later, will be calculated based on the effective interest rate. And of course we're told in the question that the effective interest rate, which is sometimes called the internal rate of return, is 9.9%. So there you can see in the calculation 9.9% of the initially recognized amount of 36 million, and of course calculated for 6/12, which is a 6-month period, the effective interest income that will be recognized in the books of Delta for the period ending the 30th of September 2013 is 1.782 million. So therefore, the financial asset will be held at year end at 37.78 million. Now, the interest is receivable in arrears. Now, the interest is calculated with respect to the coupon rate of the bond, which is 4%, with respect to the par value. So 4% of the par value is $1.6 million, and that interest will be received in arrears, i.e. after year end. And once that interest is received, the financial asset on the books of Delta will be reduced by $1.6 million and the carrying amount will be $36.18 million. So in the statement of financial position, we recognize a current asset, and the current asset is the amount that's receivable in the next accounting period, that's 1.6 million. And we also recognize a non-current asset, which is the remaining amount once the 1.6 million has been received. Now, we're also told in this question that until the 31st of October 2013, Epsilon was a successful company with a good reputation for settling all of its liabilities on their due dates. However, due to an event which occurred on the 31st of October 2013, 3 of Epsilon's major customers became insolvent, and this caused liquidity problems for Epsilon. Again, we're told during November 2013, Epsilon entered into negotiations with all of its creditors, and of course that would include Delta. Delta agreed to forego the interest payment due to it on the 31st of March 2014 and 15, with the payments from the 31st of March 2016 onwards resuming as normal. So we're required to explain and show how this event would be reported in the financial statements of Delta for the year ended the 30th of September 2013. You do not need to quantify the amounts. So these liquidity problems, they give us evidence of a condition that arises after the reporting period. And with IAS 10, this is classified as a non-adjusting event because it does not relate to conditions that were prevalent at the reporting date. So therefore, IAS 10, if we classify this event as a non-adjusting event, tells us that we must disclose this event in the notes to our accounts, and specifically, we must disclose the nature of the event and the financial effect this event could have on the financial statements. Thank you very much for watching this tutorial from the Micro Learning Institute regarding December 2013 Question 2 Delta